Welcome to Business Reporter's Future of Financial Services and Banking campaign. What can traders do in 2023 to invest smartly, reduce their risks and profit from their skills? Beyond experience, perseverance and hard work, they must rely on the platforms and brokers who offer them access to the markets. But many traders will testify that not all platforms are reliable. A naive investor can fall victim to fraudulent tricks and twists and suffer an undeserved loss. But these losses are avoidable as long as you're working with a reliable partner like a reputable market maker. But how do you find the right one? And how do you improve your trading skills? Well, in this series, Damien Bunce, Chief Customer Officer at Exness, guides us through the most important steps, from teaming up with a market maker to using leverage responsibly. Exness is the world's largest multi-asset retail market maker, employing more than 2,000 professionals worldwide. Just explain to me though, what's the difference between market makers and brokers?
I appreciate it's a term that's not widely understood. So people think of the market as one big place. It's not. It's a patchwork of liquidity sources all over the world, some with special expertise in certain products. The market maker's role is to piece that patchwork together to create a really compelling price and then provide those prices for clients to buy and sell. So they're an intermediary between buyers and sellers.
Tell me more about how market makers profit from their services.
A market maker, unlike a more standard broker, benefits purely from what's called spread. And spread is the difference between the buying and the selling price. So if you sign up and trade with Exness and you decide you're going to buy gold, for example, there's a transaction associated, a transaction fee called spread associated with making that purchase.
So if, as you told me, that you create the price as a market maker, which presumably suits you, how can I, as a trader, guarantee that it suits me too? Is there a conflict of interest here?
There's definitely no conflict of interest, and at the end of the day, if the price doesn't suit you, then you're not going to trade. Our job as a market maker is to create the most liquid market as possible and the most buyers and sellers so that you always have a price that's favourable to you. Our goal is to create a price as more competitive than anyone else, because then you'll always trade with us. So there's absolutely no conflict of interest with your trading and the market maker. My goal and the way that we earn money is to find a buyer when you're selling, or vice versa. And for that, we charge a fee.
Damien, we've seen a lot of geopolitical and economic turmoil over the past few years. Is today really the best time to trade?
Well, you're absolutely right. It's been a chaotic period, but now is the best time to trade. You would have read about the crypto meltdown, FTX failing. We all know from the newspapers about inflation, the cost of living, not to mention the war that started last year. But all of these factors play out in the capital markets and they create volatility. And where there's volatility, there's opportunity. But not to forget that it's also a place where you can lose money.
What are the most important things that you need to consider once you start buying and selling?
It's important to go into a market with your eyes wide open, because whilst there's opportunities to make money, there's many opportunities to lose money. It's important, first off, that you've already made that consideration that there may be downside as well as upside. Secondly, you need to think through what is it that you want to trade. And maybe you're interested in trading gold or oil because you're hearing about these things in the news. Maybe it's crypto. But you need to sort of get an understanding as to what time of day it is, because liquidity is important. So start your trading in terms of a liquid market when the main sessions are running, not Sunday night at 10 o'clock when the only market that's open is Wellington and then the Japanese market opens and creates a gap. I mean, these are some of the basics, is to understand what time of day is it, etc. To be sure on what asset you're trading, to be mindful to economic news. So if the Fed, or the European Central Bank or the Bank of England are making announcements at 2 o'clock in the afternoon, that's a time that you might want to avoid unless you have a very specific strategy, because that creates maybe unnecessary volatility and it could lead to losses.
If knowledge is power, give us some knowledge about some of the other common pitfalls that traders should be avoiding.
Well, I think it's important that when you trade, that you set what's called a stop loss and take profit parameters, because they are control mechanisms that limit your downside. They may also limit your upside, but it prevents a sort of a reversal when you're making money. So if you're making money, better to lock it in at a certain level than get too greedy and lose it all again. But equally, be prepared for, well, if the market moves against me, I've set a stop loss. So I think that's important, is setting stop losses, etc. And as I said, the economic calendar's relevant. News has a big impact, on markets. I could add that, a recognition that slippage can occur. It's a nasty in the industry. It's not intuitive, but markets can gap, and when the prices gap, you can find yourself being executed at prices that weren't favourable to you.
Damien, very insightful. Thank you very much. Just tee us up for the next episode, though. What can we expect to learn?
Next episode, we're really going to focus on some of the details, the specifics. So slippage is an example. We hear it a lot. We'll talk about what it actually means, what protection measures and advantages that the market maker can bring to help our clients navigate choppy times.
Thank you. That was Damien Bunce, Chief Customer Officer at Exness.